Italy just tripled the flat tax bill for millionaires, from $100,000 to $300,000 overnight. If you're earning between $50K and $200K remotely, this isn't your problem. It's your opportunity. While the billionaire class is reeling from that shock, the back door for sophisticated nomads is wider than ever. The 7% flat tax is now accessible in significantly larger towns, offering a decade of fiscal peace. Italy just sent a massive shockwave through the high net worth community. As of March 2026, the famous flat tax for new residents has effectively tripled, rising from $100,000 to $300,000 annually. Shocking. This lump sum taxation was the go-to move for ultra-high earners to shield their global income from Italy's progressive rates, which can hit 43% to you too. But for nomads earning between $50,000 and $200,000, this hike isn't a threat, it's a signal. The Italian government is hungry for revenue, and they are starting at the top. Heading into 2027, the gap between the elite programs and the incentive programs is widening. If you aren't clearing seven figures, the $300,000 entry fee is a non-starter. However, this shift has preserved a much more lucrative deal for the rest of us: the Southern 7% regime. This is the ultimate plan B for those who missed out on the old Portuguese NHR, but these windows of opportunity close without warning. The 7% flat tax used to be a gamble on rural isolation, restricted to tiny hamlets in southern Italy. That changed in April 2026. Italy has officially expanded the regime to towns with populations of up to 30,000 residents. Throy. This is a massive lifestyle upgrade for the digital nomad. You are no longer limited to ghost towns with dial-up speeds. You can now target coastal hubs in Sicily, Sardinia, or Puglia that actually have the infrastructure a modern business requires. We're talking about vibrant municipalities where your Wise or Revolut cards are accepted at every cafe and fiber optic internet is the standard, not the exception. Ishtaishur 5. Unlike the 2025 rules that forced you into the middle of nowhere, this expansion allows you to maintain a high-velocity lifestyle while locking in a 7% rate on all foreign-sourced income for a 10-year deal. For a remote entrepreneur earning $100,000, that's a savings of $25,000 every single year compared to standard Italian rates. By 2027, these larger towns will likely see an influx of talent, so moving now is about securing early mover real estate advantages. The most misunderstood part of this deal is the word pensioner. As of April 2026, the 7% regime has become a lot more interesting because the definition of pension income is surprisingly flexible. For the FIRE community, those pursuing financial independence and early retirement, this is your primary lever. 7. You don't need to be 65 to qualify. If you receive regular distributions from a foreign pension fund or qualifying instruments, U.S. Social Security distributions, UK private pension drawdowns, or Australian superannuation income, you can trigger this 10-year tax holiday. Once you trigger the residency with a pension payment, all your foreign income, dividends from your Interactive Brokers portfolio, rental income from a U.S. property, or capital gains, is taxed at that flat 7%, 5%. In 2026, this is arguably the strongest territorial-style tax play in the European Union, Euroshoring. While other countries are introducing global minimum taxes, Italy's southern incentive remains a rare carve-out for those who have successfully offshored their income sources. If you're pre-retirement and your income is all active, you'll need a different entry mechanism. And that's where the golden visa path comes in. If you're an American or Canadian nomad, you can't just move to Sicily and start paying 7% without a residency permit. As of May 2026, the Italy Golden Visa remains the fastest path for those who want flexibility. The program offers a pathway for investors to secure residency without the immediate requirement to spend 183 days in the country, 9-10. The minimum investment for an innovative startup remains at $250,000, which is significantly lower than the entry price for residency in many other EU hubs. Heading into 2027, this is the most strategic move for those earning $150,000 plus who want to lock in an EU Plan B. Unlike 2025, when many European golden visas were being stripped of their real estate options, Italy's corporate and startup paths are thriving. By investing in an Italian startup, you aren't just buying a visa. You're placing capital in a growing market while securing a 7% tax ceiling on your worldwide dividends. It's a double play on capital growth and tax efficiency that very few other European jurisdictions can match in 2026. For U.S. citizens, the 7% Italian tax is only half the math. You are still subject to worldwide taxation by the IRS, 8. However, in 2026, the Foreign Earned Income Exclusion, FEIIE, allows you to exclude up to roughly $128,000 of earned income, provided you meet the 330-day physical presence test, 10-11. The magic happens when you layer the Italy-US tax treaty on top of this. A tax treaty determines which country has primary taxing rights to avoid double taxation, territorial. Since Italy's 7% is a substitute tax, you pay that to Italy first and then use foreign tax credits to offset any remaining US liability on your passive income. This is critical for nomads who use interactive brokers to hold ETFs like YWCE or VUSE 513. If you're living in a 30,000 resident town in Puglia, your total global tax rate could drop to single digits legally. By 2027, with global tax transparency increasing through CRS and AML protocols, having a treaty-protected residency like Italy is much safer than hiding in a traditional tax haven that lacks a robust treaty network. 14-15. The trend across Europe is toward fiscal normalization. While Italy is currently offering incentives in 2026, the era of the cheap move to Europe is fading. 16. We've already seen Portugal nuke its original NHR regime, replacing it with the more restrictive IFISI Tuquesum. Italy's recent tripling of the high-end flat tax is the first domino to fall in their own restructuring. Raya. Historically, when the elite price goes up, the middle-class incentive is reorganized or capped shortly after. Heading into 2027, the pressure from the EU to eliminate harmful tax competition will likely force Italy to either shrink the population threshold back down or increase the 7% rate. If you are currently using tools like Wise and Revolut to manage a borderless income, you have the liquidity to move fast. 4-5. Locking in your residency before the end of 2026 ensures you are grandfathered into the 10-year deal. This isn't just about moving for the weather, it's about making a deliberate trade-off to protect your wealth during the most volatile decade of tax history. The last nomad tax window that closed this fast was Portugal NHR in 2023, and the queue to reverse that decision is still empty. Italy is raising the drawbridge for the ultra-wealthy, but the 7% path for sophisticated nomads remains open for those who move before 2027. You now know exactly how the 30,000 resident town expansion and the pensioner loophole can drop your tax rate to the single digits. If this is saving you money, hit like. It helps more nomads find this channel. Subscribe. We break down a new high-level nomad finance strategy every week. Next video: the top 3 banks that won't close your account just because you live in Italy.